If you go back and look at the bull markets of gold, the gold is generated since it was legalized in 1975. Both of the bull markets, different price zones, different time spans, were eightfold gains from bear low to bull high. Eightfold. 1976 low to 1980. 2001 to 2011. 8 times the low of the bear market that preceded it. Our bear market low was 1,050. It means you could go well over 8,000 just to simply match what gold has done twice before since it's been legalized. Silver broke out relative to gold when you plot a spread chart of the two. Broke out over a 10-year range. Still very dirt cheap. Silver go to 300 to 500 and do so very rapidly. I think we're on the cusp of that. We'll see probably in the next week or two. The technicals of silver versus gold say buy silver, not gold.
Gold and silver markets may be approaching a turning point as long-term momentum indicators begin to improve. Recent price action has created uncertainty among investors, but larger structural trends continue to suggest that precious metals remain in a powerful secular bull market. While short-term volatility can shake confidence, the broader picture points toward monetary metals benefiting from ongoing currency debasement and growing concerns about the stability of the global financial system. Michaeloliver, a respected market analyst known for his momentum-based approach to forecasting, argues that recent price swings should be viewed in the context of a much larger long-term trend. His analysis focuses on momentum rather than headlines, emphasizing that major market moves often develop before conventional narratives catch up. Looking back at previous gold bull markets since legalization in the 1970s, he notes that both major advances produced gains of roughly 8 times the preceding bear market lows. Applying that historical framework to the current cycle suggests gold could eventually move well above $8,000. At the same time, silver appears significantly undervalued relative to gold and may be positioned for a powerful catch-up move if momentum continues strengthening. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Noise element on the side. You're going to hear a lot of stories about supply demand increase or whatever. China's doing this, or the issue you just brought up about futures versus real bullion or whatever. The Chinese pricing versus our pricing of silver, big difference there. All these things are just going to be rumbling around on the side. Some positive, most of them probably positive, but some negative. People can say, oh, that's all that matters. No, it doesn't. What matters is the ongoing decay in the money unit, and silver is money. Mm-hmm. People think of it only as an industrial metal now, but it moves with gold. It does not move. If you go back and look at the Bloomberg Commodity Index, for example, and think, well, silver moves like a commodity. No, it doesn't. It moves with gold. Now, often it moves with gold to a lesser extent. Meaning gold might have a good move and silver has a good move, but less than gold. Right now, that has totally shifted. That changed back last November. Silver broke out relative to gold when you plot a spread chart of the two. Broke out over a 10-year range. Still very dirt cheap. So as this money supply is the real issue, as that increases, because the Fed has to print to save the bonds. And I take that quote from the Prime Minister of Japan, who was elected a year or so ago, and she said, she's supposed to be a conservative type, we're going to print to save the bonds. Well, I mean, it's increase the money supply. Well, we take the book from Japan all the time. Bernanke did back in 2008, after we crashed the stock market in October, a full year off the high. 2007 in October, 2008. In October 2008, you had like a crash month, and Lehman Brothers went out the month before. Finally, Bernanke said, screw it, I'm going to do QEs. Took a book out of the Japanese, page out of the Japanese book. We're doing the same thing now. So really the main issue is not this, that, or the other short-term metric like commitment to traders report or open interest in the COMEX, so forth and so on. Reality lives underneath all that. And ultimately these seeming deviations or whatever you might see, they're going to be flushed out of the way. And also manipulation will too. I mean, if silver was manipulated, and I can buy that argument, I'll tell you why in a minute, but it's no longer. It's saying, I'm out of here, guys. I'm not going to stay in that 50-year confinement that I was in. Heck, copper didn't stay in its. Copper was in the range for decades between 50 cents and $1.50 a pound. In late 2005, it broke out, and you know what happened? In several quarters, it quadrupled in price. Several quarters. $4.10. Now we're $6.30. Okay. Same thing with lead. Lead did the same thing, a multi-decade sleepy little range like silver had, $5 to 55 to 55, et cetera. Lead broke out in 2010, quadrupled in several quarters. Went to a new reality. Boom. Didn't even have headlines. Now silver broke out of that $50 range, and we're not that far above it now. We're $69, $68 right now on a pullback. It is yet to reach its new reality, and our assessment is on a variety of reasons. Technical, archival history of other markets that have done the same thing, like copper and lead. Silver go to 300 to 500 and do so very rapidly. In fact, my bet is you come out of this congestion zone that we're in. Let's say you show the evidence of that in the next several weeks or month, our momentum evidence. You don't have to wait for price to go to 100 to prove the issue. And I think you could be in that zone within a handful of months. So all these issues you raised, they're noise, And whoever tried to restrain silver for 50 years, copper wasn't, gold wasn't, lead wasn't. How come silver was stuck in a 50 range? What's wrong with it? It says, hey, no more. I made a mistake. I'm coming out of here. And I think it's a tantrum. And we've not even seen the tantrum yet. If you go back and look at the bull markets of gold, the gold is generated since it was legalized in 1975. Both of the bull markets, different price zones, different time spans, were 8-fold gains from bear low to bull high. 8-fold. 1976 low to 1980. 2001 to 2011. 8 times the low of the bear market that preceded it. Our bear market low was 1,050. It means you could go well over 8,000 just to simply match what gold has done twice before since it's been legalized. Okay, that's no big deal. It's saying, oh, I did it before, I'll do it again. Okay, big deal. 3 times. The fundamentals out there and the technicals say, no, you might go a lot further than that. But at minimum, if you went there, that's not really overdone. It's something you've done twice before. Silver, on the other hand, hasn't done that. It's only recently that it managed to get up out of that range. It's like, gold went up to 850 in 1980. It's like silver is only just now, late last year, finally taken out that high of 1980. Okay, gold took it out twice now, and I think silver's going to go in a tantrum type way to a new reality to get more relative valuation to gold than it currently is, which is like 1.6% of an ounce of gold. I think it could go back up to where it was in 1980, 6.5% price, meaning quintuple its relative value to gold. So that again emphasizes, and the technicals verify this, the technicals of silver versus gold say buy silver, not gold. That the place to be in the monetary metals now is no longer the mama metal, it's silver and the miners, with emphasis on the silver miners.
A key part of the outlook centers on silver's relationship to gold. Rather than behaving like a traditional industrial commodity, silver has historically moved in step with gold during major monetary shifts. The focus, therefore, remains on the declining purchasing power of fiat currencies rather than temporary fluctuations in industrial demand or supply narratives. Various factors may influence sentiment, including developments in China, futures markets, and differences between Eastern and Western pricing structures. However, those issues are considered secondary to the broader monetary trend. The underlying argument is that precious metals ultimately respond to the condition of the currency system itself. As confidence in paper money weakens, monetary metals tend to attract increasing attention. Technical indicators currently suggest silver is outperforming gold on a relative basis, suggesting it could become the stronger performer during the next phase of the cycle. If momentum continues to build, investors may begin recognizing that a new trend is emerging rather than another temporary rally. Now, let's get back to the interview.
If you look at silver and gold since 2015, they've risen nicely, okay? Silver far more erratic than gold, but nevertheless an upward bias. And if you flicked out of your position every time there was a shakeout of double-digit percentages, thinking, oh, that's it, you were wrong. Because the real problem then is once you got out, assuming you didn't sell the top tick of the congestion zone before the congestion occurred, where did you get back in? Or did you get back in? And I bet if you got back in, you got in higher than where you got out. Okay? Mm-hmm. So, in other words, the guy who did better looked at long-term factors, and we look at long-term momentum like silver and gold's annual momentum. What's that? It's when we measure each month's action in its oscillator relationship to, let's say, a 36-month average or a 3-year average. When we plot the bar, where is it in relation to that? Not on a price chart, but on an oscillator. And are you above it or are you below the zero line? And when you plot the oscillator, there's been no breakage in this break. It's a sharp break, but still in the context of an ongoing long-term momentum uptrend. The only thing that broke in silver and gold in that January, February break, day and a half collapse, you broke intermediate trend factors. So you cracked a knee bone and you slumped. But if you really look at what's happened since then in the healing process, is sideways on price. Up, down, above that low. In fact, silver right now is above the Feb low. Feb low was $64. It was 6 months later, 5.5, 6 months later. And where are you? You're still above it. Mm-hmm. Okay. Gold's slightly below it, $150 below it. But the point is that what we've seen over the last 5 months plus is a healing process by what was broken, intermediate trend factors, intermediate and short term. Nothing has upset the investment grade decision to be long silver or gold. Entry point is very important. Where did you get into something, whether short or long? And if you got in at appropriate technical levels, then some of this turbulence is not hurting you. Yeah, you've given back some profits, for example. If you bought silver, our last 3 buy signals of consequence were $25 to $26 in March of 24, $35 area in June of 25, and our last long-term buy signal was at $56 in November last year. So yeah, when you average those guys out, you're probably talking somewhere in the mid-30s. So yes, you saw this brief spike well above 100, 120, but that was like phantom. It was like hours or a few days, that's all. And then this sudden drop and then nothing for 5-6 months now. In fact, you can draw a line sideways through the middle of the gold and silver action and just see this, who's in charge action, up, down, up, down, up, down. And all, people are taking these headlines and acting on them. Same with the stock market. But broadly speaking, I think the stock market is topping. It may have made its high with that 7,600 reading on the S&P. We dropped down to 7,200 and change this past week. Now we're back to 74. We think the stock market is vulnerable for a major bear trend. It's likely to generate one that people will finally recognize as a bear trend later this year, but especially if we get into the third quarter, meaning a few weeks from now. There's the potential for some vulnerability that could be a real kick in the shins for a lot of people. I don't mean a crash, anything like that. I meant just, a jolt that, what's going on here? Not even any headlines to explain it, et cetera. Mm-hmm. And the opposite for gold and silver. I think they've been caught in a range that most of the damage was done in a day and a half. You go back and look at January 31st, February 3rd, last day of January, first day of February. And that was effectively circle that February 3rd low on silver, draw a line sideways. Circle that low on gold, draw a line sideways. Yes, we've been above and below it, but really not trending, just violent, confusing swings to most. I think that's now wrapping up. And we've got some numbers, I won't be too specific because they can vary week by week and day by day, but you continue this week's reversal type rally we've had in the monetary metals, at least, in some of them it's total reversal up on the week. Silver barely closed down on the week, and gold, 2 days has rallied $200. But that bounce, I think if it goes just a bit further, not a lot, you don't have to get up to like $85 silver or 90 or anything like that. We're going to trigger enough stuff that says, hey, this rally is going to be different than those other rallies that occurred within that range. This is not just another dud rally. That this one could launch through the entire congestion zone and get us going into a very steep angle of ascent. I think we're on the cusp of that. We'll see probably in the next week or two. Last week in our weekend report, we suggested, especially regarding the miners, because they made a prominent low back in, I think it was March. It's when silver made its low at $61, by the way. When it swept the February low at 64, nothing happened. Silver immediately shot back up. The miners broke through that price low. So anybody looking at a price chart said, oh, that's it. It's over with. That's the top, et cetera, et cetera. You closed the week back above it. Or you blew through the low, ran all the sell stops, and reversed the week, closed back above that low that you broke. That supposedly was the end of the world break. Okay, you're going to go down forever. I think that was probably the flush low in the monetary metals, this week's action. And it's not going to take much, follow through next week, to trigger enough intermediate trend momentum factors, the ones that were broken back in that Jan-Feb break, to say, okay, we've righted that issue. We're now, the intermediate stuff that was broken has now healed itself. It's now positive, and it's rejoining the long-term trend, because they were in opposite trends. One was still positive, one said, I'm negative now. I think the intermediate's about to shift back to positive, at which point then we'll pound the table, define it with some numbers, and suggest to people that the rally you're seeing is not just another rally. It's this time you're coming up out of here. I think that's where we are, period.
Recent market action has also strengthened the case that a significant low may already be in place for precious metals and mining shares. Sharp declines earlier in the year created widespread pessimism, yet the subsequent recovery displayed characteristics often associated with major reversals. Markets briefly moved below key support levels, triggering selling pressure before rapidly recovering. Such behavior frequently signals exhaustion among sellers and the beginning of a stronger advance. Momentum analysis suggests the long-term trend remained intact even during the correction. As those intermediate measures turn positive again, they could realign with the broader bullish trend. If that process continues, the current rally may prove fundamentally different from previous rebounds that failed within established trading ranges. A breakout from long-term congestion would likely attract new capital into both metals and mining equities. Based on historical precedent and current momentum structures, gold appears capable of extending substantially higher over time, while silver may have the potential to accelerate toward the $300 to $500 range if a major monetary revaluation unfolds. The developing setup increasingly resembles the early stages of a powerful advance rather than a routine recovery, suggesting that the next phase of the precious metals bull market could be far more dynamic than many investors currently expect. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.